Hi there, and thanks for listening to the Adulting is Easy podcast, where we make adulting easier by making money easier. This is your host, Lauren. And joined today by Mick Heyman, CFA, the author of Mellow Your Money, How to Surf the Market and Build Wealth Without Stressing Yourself Out. He's also the founder of Heyman Investment Consulting. With a 40-year career in wealth management, Mick has built a reputation for helping individuals grow and preserve their wealth through a stress-free approach to investing. Mick holds a bachelor's degree in economics from Northwestern University and is a chartered financial analyst, CFA. In addition to his book, Mick shares his insights on sound money management through articles on LinkedIn and has been featured in the Wall Street Journal. Residing in San Diego, Mick enjoys an active lifestyle, engaging in tennis, golf, surfing, practicing meditation, yoga, and Qigong. He also has a deep appreciation for mystery novels and Russian literature. To learn more about Mick's approach to investing, visit mellowyourmoney.com. Thank you so much for joining me, Mick.
Thank you, Lauren. I'm excited to be here and really appreciate it.
Yeah, I'm excited. Our goal for today is to make adulting easier for listeners, as it always is, by discussing a personal finance topic, since managing money is a big part of adulting. So today, Mick, we're going to talk about chapter 4 of your book, The Man Who Did Everything Right. The man who did everything wrong and the man who did everything right. But first, I want to know, why did you decide to write this book?
Well, there were a couple of reasons. One of them is I always dreamed as a kid to be a writer. And here I was getting towards 60 years old. And I hadn't, other than articles, I had never, kind of tackled a book. And so I thought maybe I could put together some stories to help investors learn how to chill out a little bit. That was the other thing. As I've seen, people are so, it's not something we're educated in. And there's so much, there's both a combination, I would say, of too much information and useless information that's out there. And it was really actually starting to irritate me that every day you'd hear some economist, propose this is going to happen or that's going to happen, or somebody fear mongering about this or that. And I was thinking, all you're doing is scaring people who don't really know how seriously to take what they're saying. Couple of years ago, there were so many people worrying about this great recession that was coming. Well, we're still waiting for it. And who
Yeah.
knows how many people may or may not have changed their investing because of this. And I thought, my experience is that none of these things really matter over the long term. All these short-term worries are just that. It happens in our lives. All these things we worry about every day. How many times do they really come true? And investing, it's the same. And what I found was all from the earliest days, my lessons were doing nothing, sitting with your investing is usually the best advice. And so I thought let's try to have a book that kind of mellows people out, try to focus on the long game, on the long term. And then I thought to throw in many of my experiences, both that were helpful in learning how to invest, and also my own misadventures, the things that I did wrong, and kind of help people also learn from their experiences that we're all going to make mistakes. We're all going to, stumble and bumble along. And if we can look at them as learning experiences as opposed to terrible regrets, that too can help us in our lives and in our investing. So anyway, all those things combined into trying to put these stories together.
I don't know who this quote should be attributed to, so I apologize for that. But worry and anxiety being interest paid on a debt you may not owe. Why would you pay interest on a debt you may not even owe? And that's what worrying is. That was one thing I thought of as you were talking. And then the other thing was, I think it's a Fidelity study, and some of their best investors were dead because they weren't touching their accounts. And that's so true, right? I mean, it's just the more you touch these accounts and the more you try to plan for a recession or for a change of administration like we just had, or things like that. I mean, I was on a plane one time and this lady next to me, she told me that the night Trump won, initially, she sold her everything because she thought there was going to be, of course, this drastic dip, and instead we had the Trump bump or whatever. And she's like, it cost me $100,000, that mistake right then. And she said she turned her money over to a money manager after that to keep her away from that. So, anyways, as you were talking, those were some of the things that I was thinking of.
It is amazing. And I was thinking, as you told your quote, one of my favorites is from a philosopher named Michel de Montaigne. And I think his quote was, "My life has been filled with horrible miseries, most of which never happened."
Exactly right.
And we just focus on that stuff. And you're right that actually it was my first client who never knew how much she had. Her only focus was to be provided a couple of $1,000s a month to give it away. She knew she had, as long as she had the income, that she wasn't worried about anything. And so with her investments, they had such long-term gains on them, we did nothing. And so we nicknamed that our strategy of benign neglect. And at the end of the year, invariably, if you asked who did better, LOEs or all these other clients that we were trading in and out of trying to take advantage of market moves, LOEs was the winner again. And sitting actually outperformed doing.
That was my second choice. Other, if we weren't going to cover chapter four, I was going to cover benign neglect. But so getting into chapter four, then tell us about the man who did everything wrong so that we can not be this person.
Sure. And in fact, even though I make fun of him a little bit in the book, the important thing is we all have potential to be both the man who did everything wrong or the man or woman that did everything right. We all have the psychology of that potential. And so I try to make fun, but also reflect back that just like in some of Seinfeld's characters that we laugh at, we all have the potential to bumble and stumble. And so as I go into it, this fellow retired with about $1 million. And the first thing he did was hire an investment advisor. But what he never asked was, what's your strategy? What's the potential risk in what you're doing? And this was a very aggressive advisor. And this is back in the 80s. And bonds were very volatile back in the 80s because of fears of inflation and such. And so they bought 100% in long bonds. And you think, well, bonds would be safe, except when interest rates are moving up and down. If
Mhm.
you've locked in at 6% and rates go to 10% and you have 30-year bonds, imagine that bond could go down from 100 down to 60 or 70 because of the long-term nature of the thing. Anyway, that's what happened. He had 100% in long bonds. Interest rates rose dramatically during the year as the stock market rose. He had no stocks. So he's watching all of his friends make money in stocks. His bonds are dropping like a rock. And he's thinking, this is terrible. What have you done? And he fires those guys. And so he, of course, is taking less money over to another advisor who happened to be us. And so he says, okay, what are you going to do? And we say, well, we're more balanced managers. We're going to keep a few of those long bonds, but we're going to balance that with stocks and with short-term money, which we thought was safer over the long term. Well, unfortunately, when we did do that, and thankfully we didn't buy all stocks because stocks, of course, had run, but we bought maybe at that point 30 or 40% of the money in stocks. And that was invariably right before the 1987 crash, Black Monday. This is interesting too. On Black Monday, stocks dropped 22%. Now, I see all the time headlines, markets plunge because of XYZ, and markets are down 2 or 3%. And I'm thinking,
Or like
that's the
one.
wrong headline. That's a nothing. You talk about 22%. Think of it, almost a quarter of your money in stocks gone like that. And so that was a shock to the system. And of course, what did he do? Immediately said, how could you buy these stocks? And of course, he didn't have that many stocks, if you think 20, 30, whatever percent in the portfolio, but
Right.
it was enough to scare him more. In fact, his long bonds made money on that day because people fled to safety. But his immediate reaction was fire us. He said, I'm firing you guys and I'm going to buy CDs and I'm never buying a stock and never buying a bond again. And of course, that was the bottom of the stock market. If you look at 1987 on a chart, it looks like a little blip at this point, and would have been a great time to add to his stocks and even buy some bonds. But he, of course, got scared. And imagine what CDs were paying just a few years ago. They were paying 1%, 2%. And, so strike one with buying the long bond, strike two with, selling his stocks right at the bottom. And then, of course, buying CDs, which felt safer to him, but were going to provide almost no income at some point in the future. And so that was the guy who did everything wrong. And when you look back at what were some of his mistakes, one of them was not knowing the risk at the forefront. Had somebody told him you could lose 30% on these long bonds, which probably felt safe to him,
Yeah.
maybe he wouldn't have made that first step. And
Well, the
then
diversification
yeah,
is really important. I mean, you would know better than I would, being a CFA, but I mean, what do most people do? 60/40, maybe 75/25. I mean, some sort of diversification and then having that short-term cash or whatever for when you don't want to be withdrawing from your portfolio when there's volatility or the market's down or what have you. Like nobody had that conversation with him up front, or maybe he was like, I'm too afraid of the stock market, so they did the only thing they thought they could, which was put them in bonds. I don't know. I don't
actually,
know.
from my memory of that particular firm, they had had great success in basically making 100% kind of decisions, all stocks, all bonds.
Oh,
That's what they
okay.
were about.
Jeez.
So who would hire that firm? What you might do is say you had, $1 million and you put half of it with that firm or a third of it with that could be part of
Right.
your diversification is to have some aggressive firm manage money and today that would be called a hedge fund. But I never believed in those things because I always thought exactly what you said. Be
Yeah.
diversified, be simple. You don't need to take that kind of a risk because the downside is too great.
And then you
And
don't have to be selling one to buy the other when you're trying to rebalance. If one runs, then you can rebalance by selling that. You're not, you know what I mean? Like once your portfolio on its own gets out of balance, then you can rebalance it rather than having to manually do what you guys were trying to do, which was draw down these long bonds and get over to stocks at like a weird time, you know?
Sure. And what you say too about diversification is important because why do you diversify? Because you have to understand your own personal risk tolerance. If you look at the long-term returns of stocks and bonds and cash, you'd say, why wouldn't I be 100% in stocks? They return 8 to 10% a year and bonds aren't yielding that. But it's the short term, it's understanding your own risk tolerance that's so important in that. Because what are you giving up by having 60 or 70% in stocks versus that 100? Well, you're giving up that some potential return, but what are you gaining? You're gaining that safety of, some surprise is going to happen, something out of the blue, and the market does drop 10 or 20%, and you're not in there, worrying about how much money you dropped in the market. And that's the second thing in that book is by losing more than he mentally could feel caused him to make the next bad decision. And so if you imagine you put your first $1,000 in the market, all in stocks, and it goes to $600 because of some bad decline. That
Mhm.
may cause you to never buy a stock again.
That happened to my
And
grandparents. Speaking of Black Monday, I mean, right before that, they put their money in and they never put it back after that. And my grandma, she's 92 now, maybe 5 years ago. So what would that have made her? 87. She goes, if I hadn't touched it, I'd be a millionaire, and she realized
And,
it, but yeah, it's hard, but also what's, you know, when things drop, if you can buy more, that's the time, right? You're just like, if you bought a pair of shoes and you like the pair of shoes at $100 and the shoes go down and now they're $60, like why maybe buy another pair? You know what I mean? You're gonna need more
it's
shoes, right?
because if God forbid you're watching social media or somebody on TV, they're going to try to scare the heck out of you
It's true.
because the headlines are always terrible at the bottom. They're always telling you why they're going to go down further.
Right.
And that was the
And
other thing on
sometimes they
that black.
can. I mean, you can't like, yeah, like it's you're not guaranteed like, oh, we're done now. Just because the market drops 22% doesn't mean it's not going to drop anymore, you know?
Exactly. But that is the case of averaging in and going slowly. And if you're putting in that $100 a month or $1,000 a month, whatever it is that someone could put in, you're neutral about it. You're saying, if you're going slow about it, you're saying, gosh, if the market drops, I'm getting that shoe cheaper. If it's up, you're feeling, oh, good, I made some money.
Yeah.
And so
My
I
shoes
think
are worth
that's
more
the
now.
other the benefit of averaging in and diversifying like what you're talking about is really I think the key to that long-term success. But if you're so focused on the noise around us, you won't do those things. You're going to be scared at the bottom. You're going to be overconfident at the top.
And one more thing I want to say, I don't know if it's in A Random Walk Down Wall Street or The Intelligent Investor. I think it's one of those books, but he talks about, whoever the author is, talks about missing the 9 best days or in the market, or
Yes.
it's you, like if you were to do like the woman did that where she sold her portfolio right before Trump, right when Trump won, but before we got the Trump bump, she missed that great day. And that's enough. That was enough to cost her $100,000. And if you do too much timing of this market, too much trying to time the market, too much, I'm going to wait for interest rates to come back down, or I'm going to sell now, or I'm going to do this, and then I'm going to get back in. If you miss the whatever, those couple of best days over that 10-year period, your returns are astronomically lower than they would be if you had just left it and took those worst days with the best days.
Exactly. And in fact, I can't remember the exact numbers either, but it's almost like you may as well just have kept it in your bank account. Whereas if you and those best days, by the way, are not predictable. They
No.
tend to be after the worst days. They tend to
Yeah.
be right after that woman sold or right
Yeah.
after
You
Mr.
never know.
Wrong.
It could be like we made the jobs report by like a tenth of a percent, the projections, and boom, it's up. Or you could miss it and it'd be like, boom, it's up because that means interest rates are going to go down. Like you never know what is going to trigger the market. And that's human psychology. And I've read a lot about psychology. I've read a lot about the psychology of money. I'm very fascinated by these things,
Mm.
but that's human psychology. There's your own psychology, which I think is actually much harder to understand, where you sort of diverge from how most people think or how most people feel. When the we had the my adult lifetime crash was the COVID crash, which was
Sure.
incredibly short-lived, which was nice. But at the time, we didn't know what was going to happen. I mean, that was really weird. We didn't know what was going to happen, if the world was ever going to open up, if it was ending, whatever. But when that happened, what I felt was relief, which was a very odd feeling. And I would not have thought I was going to feel that way. That's a very weird thing to feel. But it's because I was like, this is the thing they've been telling me can happen. And it happened. And now I know what I feel like.
Yeah.
So, like, but I would have predicted that. So, a lot of times people say, well, how much money can you lose and still be able to sleep at night? And answering that stuff in the abstract is different than when it actually happens to you. So I was wondering if you had any thoughts about that, because I'm sure Dr. Price, I'm sure the man who did everything wrong, had some of these thoughts, but when push came to shove and when the ish hit the fan, it, I doubt he behaved like he thought he would.
Well, and I think that's the to me the difference that my experience has been with people has been the difference is explaining it in real dollars versus explaining it in percentages. If
Okay.
someone says, what could happen if something drops 20%? In your mind, you say, 20%. I mean, what does that mean? It means nothing to most of us. But if someone says, what could happen if you lost $20,000 or $200,000, that can wake you up. And that I think would have woken him up is what is it, during that 3 weeks during the pandemic, the market was dropped, I think it dropped 35%. And
Yeah.
so what happens if you had $20,000 in the market and now you've got 13, that's with that 100% portfolio in stocks. Well, if you
Yeah.
had 50-50, your $20,000 is $17,000. Not so bad. And so those are questions each of us have to ask ourselves because yes, you're giving up some return over the long run by being 50-50 or 60-40. But boy, when those surprises happen, and who would have predicted that? And there's going to be another thing. We don't know what it
Yeah.
is or when it will be, but it's always a great example too to me is that what happened during the year. Say you had fallen asleep for those 3 weeks, and you missed the 3 weeks that the market went down,
Yep.
but someone had told you the headlines at the beginning of the year, we're going to shut down the whole world. No one is going to be working, and we're going to have this horrible pandemic. And you would have sold everything at the beginning of the year, just like that woman did that you talked about. Well, the
Yeah.
market was actually up 15% for the year. It
Yeah.
made up for that 35% and then some. And
Which I
believe
would
me,
like
no
to
one would have
say,
predicted.
when you talk about percentages too, what a lot of people don't think about, when the market goes down 20%, it doesn't then need to go back up 20% to hit the same all-time high. I don't know what the math is, Mick, but maybe it's 37% or something to get back to where it was. It needs to go up a lot more than that, which is what happened, like you're saying, in 2020.
But also why, at least in my philosophy of investing, is try to avoid, you can't avoid market volatility, but by minimizing risk, by not being 100% this thing or that thing, you can then avoid those huge potholes that are hard to recover from, because you're absolutely right. To recover from that 30% down is usually takes time. It didn't that year, which we wouldn't have predicted either, I don't think.
No, no, how could you? Um, okay, so let's talk about the couple that did everything right then and contrast this a little bit and let's see if we can behave more like them.
Sure. And so they walked into me and also had just retired. And this was my first chance to kind of try to take on a client on my own. My boss said, go ahead and see what you can do. And I knew the story. I knew that based on their objectives, they had enough money. They were just retiring. They had Social Security. They had some retirement plans, and they were just looking for some income off of this portfolio, but they were worried. And so the thought was to take a very moderate approach as opposed to being 60-40. It was more 35-40 in stocks and the rest in bonds and cash. So be conservative. But even within that conservative nature, they had this sense about them like, we grew up through the 20s, the 1920s, by the way, and they were worried about the 29 crash.
Sure.
And I, thought for a moment, and I took a pause, but I went with the dollar thing. I said, well, let's look at how much the market dropped in 1929, and let's, assume that would happen in your portfolio, and your portfolio would drop, 50, $60,000 off of $1 million or so. And if that happened, how would you feel? Would you be okay? Would you be scared? And they said, no, that's a reasonable downside of what we would expect. And I said, would you have strong hands? Would you be willing to buy if that happened? And yes, the answer was yes. And so, ironically, 3 weeks later, Black Monday happens and the market crashes. And I'm thinking to myself, I got to call them up. And I wished I had listened to them. Somehow they knew there was a crash coming. And of course, you don't do that. But I call them up and I'm expecting the Dr. Price, oh my God, you're fired kind of thing. And
Yeah.
instead it was, Mick, you said what would happen. What's the value of our portfolio? And of course, it was close to what I had said would happen if the market dropped like that. And they said, well, you said to buy stocks. We ought to buy some now. They're cheaper. And it was a total calming. These are older people that could have been scared and everything else, but because they had this expectation in mind, they weren't. They had strong hands. And so we did buy stocks. And in fact, they were a perfect example of, they were long-term clients for for over 20 years until they passed on. And and two, at the end of their lives, they had about the same amount of money after taking all this money out and giving it to their grandkids and living, for their living expenses. They actually had about the same amount of money at the end as they had when they walked in that door that first time. And so, I thought just a model of how to invest and be patient over the long run.
So you think a lot of their behavior came from communication and education around expectations, what could happen. Maybe that's maybe that's how I felt during the COVID crash, where I was like, okay, I knew this could happen. I knew this was a possibility. I didn't live through 1929. I lived through 2008, and that was pretty rough. I mean, I remember my dad
Terrible.
I'm 18, 19 at the time, and my dad's like, "I lost $200,000 this week." I was like, "That sounds bad. Like, why are you saying it like that?" He's like, it'll come back." But that was like an entire lost decade type thing when he was 48 years old and he was chill about it. So I think I must have had some of that in me when it happened to my own portfolio when I was 30.
I fortunately, as quote mellow as I am, I remember being in an airport watching the first part of that drop in 2008. Of course, it lasted almost 6 months, and I had to call my dad up, who at the time was probably in his 80s, and and he had to say, "Well, Mick, remember, things come back. Remember what you've been telling me for 20 years." And of course, I even needed to be reminded because, yeah, it seemed like I myself could have been channeling Mr. Wrong at that point because it looked pretty bad. And so being able to laugh at ourselves and getting in touch with our own emotions is really, really important. And I think that's the other lesson I've learned over time, both for myself and my clients, is emotions haven't changed, they don't change for, looking back hundreds of thousands of years. And we forget that that's what drives these markets. And it's not numbers, thankfully, because if it were numbers, I couldn't do it.
Well, in the book, I'm just like full of books today, but in the book Sapiens, it kind of covers the history of humans, history of humanity. And one of the themes from that book is we have our technology and the way society has changed has evolved faster than we have physically. And so we still, yes, while we have all of this technology and computers and the sophisticated society and all of these things, we're still deep down those hunter gatherers from the plains of Africa. We have not nearly evolved as much as the world around us, as much as we've forced the change upon the world around us. We have not changed as much.
I love that book, by the way. I've also read it, and there's a quote in there. I'm going to misquote it, but I love it because I have a teenage daughter, by the way. And he said, even back in the caveman days, there is some teenage girl rolling her eyes at her parents because of how stupid they sound. And I thought, exactly.
Yeah, so we what should, 20s somethings, 30 somethings, young 40 somethings, the people who mostly listen to this podcast, love all of you that are on the tails of the bell curve, but let's talk to those people in the middle of the bell curve of the listeners right now. What should they be doing and thinking about when it comes to their money, their portfolios, their future? If you had like one thing you could say to them.
Well, and I think you've emphasized it in so many of your podcasts, but what the way my one of my clients says to his grandkids is pay yourself first. Make sure that it's not an end of the month thing, it's a beginning of the month thing. Back when you're paying your rent and you're paying your utilities, um, put some money away. And I believe it was again in one of your podcasts. If you just start with $1,000 and put $100 away each month, it's $100,000. And so putting money away is number one. You don't get there. I have a teacher I worked for from Cincinnati, Ohio. They don't get paid a whole lot back then, and she just saved money every month and such, and now she has several $1 million to supplement her retirement, and that just from was just walking forward and had a you still have to have a quality life, but you can do that while putting money away. And then, as we've talked about, understanding what kind of risk could you take with that $100 or whatever it is, and don't um, be swayed by what you're seeing on social media about this quick money thing. That doesn't mean that you can't on a weekend put $5 on a sports team or experiment with cryptocurrency. Maybe that's part of your budget too if you want to. But with your main savings, think 20, 30, 40 years ahead of you and be balanced like we talked about and understand how much could you lose before you bail out and do nothing. And so that would be number two as far as understanding your own risk tolerance and your own ability to take risk. If it is in your soul to be risky, have that be a percentage of what you've done. Don't make that the whole thing. And I've seen that hurt people over time. I don't want to be about take no risk in life. That wouldn't be fun either. And so, but make that be a percentage of what you do, and then expect that surprises will happen. Things will come out of the blue that will shock us both in our lives and in the market, and accept that that might happen, and yet life moves on. And if you bet that the end of the world is happening, because of Pearl Harbor, or because of the Kennedy assassination or 2008, it was a bad bet. And so assume that things will work out in the end. And so those are kind of the main things I think I'd say. And then also be willing to be a mechanic with your investing. Sometimes like today, the market's been up for several years. So you say you started with that 60% in stocks
Yeah.
and now it's 70% because of the market moving up. Take a profit, but move it back to your target. And I'm not saying the market's going to go down by saying this. I'm just saying that most of the time when I've sold before a market decline, it wasn't because I predicted it. It was simply because I was taking people back to their original target allocation. Same thing if the market goes down. You're 60% and the market goes down, and get back to that 60% because that's your long-term goal. And it does take the fun out of predicting, but indeed, I think being a mechanic often is the way to be successful over the long run.
Over the long run, too, you can be right for the long run. You were right all along to be investing and to be doing what you were doing. And I'd rather have that than be right in the short run over a couple of little things.
Absolutely. And I think that's what I found over, working with clients, some for over 30 years, that being patient and sitting while others were getting excited was really the way to go.
And that's something that financial advisors are really good for. I don't currently have one. I don't have complicated
Mm.
tax situations. I do the DIY thing. It's not that I will never have one, but I think the best thing you guys do is be a sounding board for people, be someone that they trust, and be standing between someone and their own psychology at certain moments as best as you can. I mean, you can't always keep people from firing you and doing what they want to do, but if there's one extra step, one extra person, one extra phone conversation between them and reacting badly, I think that's the best thing that you guys do for people.
I think that education is important, but I will say that one thing I heard in your podcast with your husband is one of the things that you backed away from is because of fees. And so in our business, whether it's a mutual fund or an advisor, sometimes fees aren't really talked about and they can be important. And so before you jump in with an advisor, make sure what you're paying and how much that might impact your long-term return. And that versus walking in and if you can deal with your own psychology and through podcasts such as yourself and kind of whether you're doing it on your own or with a low cost Schwab Fidelity. By the way, I don't work with them, but working with people that aren't going to cost you a percent or two, that can help over the long run too.
Yeah, that's a good point. Very good addition. And it's not just the percentages. There can be load fees going in, going out. I mean, there's a lot to understand around that. So I'm glad you brought that up. Is there anything else you want to add?
I think the last thing I probably want to add is just from my experiences, um, learn from your experiences. Don't look at them always with regret or, oh my God, how could I have done that? You know, we all do those things. But if we can look at our experiences as tuition and learn from those, and as well as from sometimes the most uncomfortable people in our lives can teach us things too. And so I've tried to over time, of course, we all, stumble, but to look at our experience as lessons, I think that would be one of the greatest things I'd pass on.
That's some of the best parts of your book are those lessons. And they can find your book at mellowyourmoney.com, right, Mick?
Absolutely, and of course through Amazon and such.
Sure.
But through that website and my email there, happy to correspond with anybody. I've thankfully at the point in my career where I've got a little extra time, so happy to answer questions if they come up.
Awesome. You guys can follow me on Twitter at Adulting is Easy, Instagram Adulting is Easy Real, YouTube at Adulting is Easy. If you guys like this episode, there's a ton of them. Mick mentioned some, but you can go to 168 to keep finance personal, get your time, energy, and financials right. That is with my friend Cody, who's a financial advisor. Thanks again for listening, everybody. Hopefully, Mick and I have made adulting a little easier for you.